Welcome to the Growth Cap podcast, where we chat with CEOs, investors, and other key industry leaders to uncover insights and strategies for accelerating growth and succeeding in business. I'm your host, RJ Lumba. In this episode, we chat with Dave Butler and Rick Firmine of Argosy Real Estate Partners, a fund manager with $1.3 billion currently under management. It has invested $5.5 billion in gross real estate investments since inception, and operates out of 3 offices in Philadelphia, Denver, and San Francisco. Argosy has proven that a unique investment approach can lead to a sustainable competitive advantage over the long run. As one of the few institutional diversified real estate fund managers focused on the underserved lower middle market, the firm has created value for institutional investors, family offices, and high net worth individuals over many years. Dave and Rick speak to their strategy, the trends they are seeing in the market, and also share with us the tax advantages of investing in opportunity zones. We hope you enjoy the show. So Dave and Rick, thank you so much for joining. I know we've been planning this for some time now. Really excited to chat. We're going to cover both, what you're doing specifically within Argosy real estate, but also chat a little bit about the broader topic of the real estate market as well as opportunity zones in particular. But to kick off, perhaps, Dave, you could tell us a little bit about your background.
Thanks, RJ. I've actually been on the real estate principal side of the business now for about 20 years. I came from an institutional investment background, worked for a few large firms, including JP Morgan, and prior to moving to the investment side, I was in the investment banking business, was focused mostly on raising capital and advising real estate companies. And while I was at JP Morgan, I saw a large number of very attractive, smaller investment opportunities that were very compelling nonetheless, but were just too small for firms like them to efficiently deploy capital into. So I was very interested in trying to build a fund business around these smaller to mid-sized property that I saw, and just because I felt that there was a lot more inefficiency there. And my partner Andy Stewart and I found a home at Argosy just about 10 years ago. They were very established on the fund management side of the business, on the corporate private equity side of things, but not so much on real estate. And they were looking to build it out, and we've been there now, as I said, over 10 years, and it's been a very good fit.
It's been great to see how you've grown that real estate arm of Argosy over the years. And I've been, keeping in touch, of course, with Rick and hearing more and more about what you're doing. So it's been really great to see, how you've built and grown the platform. You've kind of produced a consistent track record, over time. Can you share with us a little bit more about the platform, and in particular, the real estate group?
Yeah, so as I mentioned, it's been about 10 years now. We started with a very small AUM on the real estate side, and we've decided to purposely focus on keeping our funds smaller, generally below 400 million in size, and just to expand into various strategies. We started with an opportunistic strategy only. We've since added a core plus strategy and the opportunity zone strategy, which Rick will talk about here a bit more in detail later. But by staying small, we're staying in the lower middle market, which we like. And there's been a very pronounced trend towards larger funds in the market. The average closed fund last year in real estate was nearly $1 billion. And there's a very small number of firms that are increasingly raising a bigger chunk of the capital. So it's being generally concentrated into fewer players and bigger funds. So we don't really mind that because we've still been able to raise capital while the big guys are all competing against each other for a smaller number of deals. But our model is that we are a diversified allocator fund. So we invest in various asset classes, including multifamily and office, retail, lodging, and residential land. We focus on the top 35 markets in the U.S. At any one time, we're focused on about 10 to 15 of those. We have been spending a lot of time on these emerging secondary markets and suburban primary markets, even pre-COVID, which post-COVID, there's a big push for these lifestyle and affordability-driven markets, sort of secondary technology markets, and we've been playing in those markets for a long period of time. So we have the contacts and the expertise to play well in those markets. But our model, as I mentioned, we're an allocator, so we predominantly invest in joint ventures with operating partners and development partners who are based in those markets. They run the projects day to day, but we have the ultimate decision control as the 51 to say 90% owner of the property.
And you touched on this a little bit, but what's on everyone's mind now is how the pandemic is going to impact real estate going forward. Is this something we could touch on a little bit? Do you have some kind of insights into how kind of you foresee the market trending?
Yeah, post-pandemic, it really depends on the asset class. So we have historically spent a lot of time on the lodging asset class, which has been hit the hardest by far out of all of them. And I'd say retail is probably the second most hit, followed by office. So as long as you have capital and are patient and can find those opportunities, we think over the next year or two, there's going to be some very interesting opportunities coming out of COVID. But as I mentioned earlier, kind of the rotation out of the larger top cities, very, very urban environments, and the move to more affordability driven and lifestyle and lower tax rate states. You're seeing kind of the move of a lot of people from New York into Florida and from California into nearby lower tax rate states. We think that's a trend that started pre-COVID and is just going to continue going forward here.
Yeah, it's interesting, even just anecdotally, and this is completely separate, but on the residential side, we're seeing property values surprisingly go up, even around where I live in Princeton, where it seemed almost over a decade or even 2 decades, real estate prices, residential real estate values had stayed flat, and all of a sudden we're starting to see movement. So it's really, and that's because of the move out of urban, the folks moving out of urban areas towards the suburbs. So maybe, switching gears a little bit, excited to learn more about opportunity zones. It's something that, I know Rick and I have chatted about in the past, and, our audience will be keen to learn about this topic as well, because it is there are kind of dual or maybe even, multiple advantages in investing in opportunity zones. So would love to switch gears here and talk a little bit more about opportunity zones and why folks, maybe in particular family offices, should be keen on learning about this strategy.
Yeah, sure. RJ, maybe many folks may already be familiar with opportunity zones, but maybe I'll just start with a very high level overview of what it is and go from there. But, the qualified opportunity zones were really created as part of the Tax Cuts and Jobs Act of 2017, which was really a bipartisan effort to spur investment and growth in low-income areas. There's roughly 8,700 zones throughout the country. Each one was selected by the governor of each state that met certain low-income requirements. And at a very high level, there's basically 3 federal tax benefits that you get when you invest in a qualified opportunity zone. The first one is a deferral. So let's just say, RJ, you sold your Apple stock. Hopefully you own a bunch of Apple stock right now. You sell it today. You've got a big capital gain. Typically, you would have to pay the tax liability on that gain on your 2020 tax return. If you roll the proceeds into a qualified opportunity zone business, then you would not have to pay the tax liability on that until 2026, end of 2026, actually fill the form out in 2027. So that's obviously a big benefit. You get to keep those dollars that you'd otherwise pay to the IRS and invest and hopefully get a return on that investment. The second investment or benefit is effectively you would get a step up in basis on that investment that you sold and realized a capital gain of anywhere between 10 and 15% when the tax becomes due in 2026. So effectively, that means you pay 10 to 15% less than you otherwise would if you paid your gains today. And then the last benefit, which is the one that gets a lot of people pretty excited, is the new investment that you make in a qualified opportunity zone. So long as you hold it for 10 years, you would not pay any capital gains when you sold the investment. So you get a 100% step up. The entire capital gains is fully excluded. There's also additional state tax benefits for those states that are conforming. However, these federal tax benefits are pretty accretive to after-tax returns just on their own. We've underwritten a lot of projects over the past couple of years, probably a couple hundred, and we're generally finding that the federal tax benefits alone typically increase your after-tax IRR by about 600 basis points over a 10-year hold period. So pretty impressive returns. In terms of, really what we're doing here at Argosy, we got involved a couple of years ago. Actually, some of our existing investors requested that we start spending time on the strategy. They were dealing with large capital gains. They didn't want to pay those taxes immediately. And they reached out to us, to be QOZ eligible, projects need to be heavy repositions or ground up developments, which has really been our core strategy for the past decade. So we were already doing this, just not necessarily in opportunity zones. We spent, the next, what do you say, Dave, the next 12 to 18 months getting smart on the program. We wanted to ensure that we were comfortable with the regulations and the various tax benefits. Spent a lot of time with our tax advisors, more than I care to admit, and ultimately got comfortable with it and decided to pursue it. So we've now made 5 investments to date. We actually just closed on our 5th investment a couple weeks ago, which is a heavy office reposition. It's a conversion from Class B, B- office building to a A+ building in downtown Sacramento. And then the other 4 projects are all ground up developments, 2 in Salt Lake City, 1 in Scottsdale, and 1 in Charleston, South Carolina. We're also, continuing to look at additional deals in other high growth markets like Nashville, Maui, and Austin. And I'd say that really all the markets and projects we invest in really stand on their own, regardless of the opportunity zone status. So we really look at the tax benefits as being an additional benefit on top of something that we've already deemed to be a good investment otherwise. And then, consistent with our investment strategies, as Dave mentioned, we see a lot of inefficiencies in the middle market space for opportunity zone deals. So a lot of the other funds that have raised capital in a multi-asset vehicle have been mega funds of, say, 500 million or more, and they're really pursuing, a limited number of larger and generally more complex deals with, what we think is greater execution risk. So again, we're focused on the middle market, staying true to the original strategy of the firm and doing smaller deals. And
do you think kind of the opportunity zone area is going to be one that you focus on for some time? I mean, how long does this kind of run for?
Yeah, over time, the benefits start to wear off. The first 2 benefits I mentioned, the deferral and the reduction, those really start to become less valuable after a 2021 investment. So we haven't drawn any conclusions here, but I think it's safe to say we're probably not going to be pursuing the strategy past 2021 to the extent that the program doesn't evolve or change and extend certain deadlines.
So it sounds like it's been an overall kind of successful program, in particular for those that are seeking ways to kind of just optimize their, capital management and not only diversifying across asset classes, but even with, various tax efficient strategies.
Yeah, that's right. I think a lot of people have obviously had capital gains in the last year or so. The markets have been strong and people are trying to diversify out of gains they've earned in the stock market or with business sales. And so there has been quite a bit of interest in the program.
This is the overall kind of, it's interesting because, we cover, various industries on this podcast, and real estate is one we revisit, from time to time because, it seems like almost everyone has some exposure to the asset class. So, maybe, beyond the opportunity zones, what other areas, and I know we touched, on this with Dave a little bit earlier, but, are there other kind of areas of real estate that, you guys find interesting?
Yeah, I mean, just to kind of echo some of what Dave has already said, we've historically been investing out of a series of, opportunistic funds, and we continue to execute on that strategy. That continues to be our bread and butter. We're on our fourth fund, and that should be fully deployed by the middle of next year. As Dave mentioned, we focus on the middle market, and the segment continues to present interesting opportunities, especially given COVID, and we're arguably in the later stage of the current cycle. And so there are a couple themes that I'll highlight that we're focused on today. The first of which, and again, this is, Dave touched on this a little bit earlier, but we are kind of focused on more suburban, single-family build-to-rent market. This market has experienced significant growth. Tenants are looking for professionally managed and amenitized single-family rental properties that are less dense than a typical apartment complex. It's a growing sector, and RJ, you are going to continue to hear and see more of this over the next decade. We're actually under construction on our first single-family rental project in North Las Vegas, and we'll be commencing our second project in Salt Lake City in the next 60 days or so. That'll be another ground-up development. And I'd say the other theme that we're focused on right now, as Dave touched on, is distress, in particular in hospitality. Obviously, hotels have been crushed from COVID, given that we have significant experience in this sector, in particular premium branded select service and extended stay hotels. We've been spending a lot of time evaluating distress opportunities. And we're looking at providing rescue capital to owners who are distressed, but we're also looking at other strategies like converting extended stay type hotels into different assets like apartments or senior living. It's actually something we were doing pre-COVID that even makes more sense today, since you can now buy these hotel assets at lower prices. So even though you could argue we're late stage in the real estate market, we continue to find interesting opportunities.
And many in our audience are actually more focused, in the tech field, either as CEOs or entrepreneurs or investors. How have it'd be interesting to hear how you've overlapped with the tech community in the past or currently.
Well, we've got a lot of tech investors in our funds. I mean, while we have larger institutional investors, a good portion of our investor base still consists of high net worths, family offices, wealth advisors, many in the San Francisco Bay Area, many folks who have created wealth over the past decade through their involvement in seed or early stage ventures. And as you know, RJ, these individuals who've had their own startup businesses or early stage investors, they tend to be pretty savvy investors and are always looking to diversify their wealth into tech and from tech into other assets like real estate. So perhaps some of your audience is already an investor in one of our funds, but if not, they certainly have similar backgrounds to a lot of our individual investors.
Got it. That's helpful. Well, we're just about up on time here, but just wanted to close out and thank you guys for taking the time. You've been very generous spending it with us, and I think our audience will find this conversation very helpful. Thank you.
Thanks, RJ.
Thank you.